Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. The hope is, after a good start yesterday, there is more to come. I'm Prashant. With me, my colleagues Nigel and Surbi. Guys, good morning.
Hi, good morning, folks. A little bit of, sprinkling of rain here and there once again in Mumbai, which is a relief because otherwise it would have gone away way too fast. So, not bad.
Well, that's right. In a couple of sessions more, it'll be the end of earnings season, which has been pretty okay. But it's a long weekend as well. So, let's get straight to the action. We've had a good start to the week.
Long weekend mode.
Indeed.
Already.
Indeed.
3 days to go, but yeah, I mean, you know, so US equities, I mean, just to take it from the top in terms of where we are, no real big indication one way or the other in terms of cues as you start today's session. I mean, at least from the US market. Friday, remember, the market was up 1%. We ended 3% higher week on week in US. And there was underperformance here in India, and we kind of sort of participated decently well across the board. But last night, I mean, nothing very much. S&P down about 0.25%, the Nasdaq down about 0.3% or so. As I said, neither here nor there, largely. Macro markets are largely quiet as well. The US 10-year yield was down about 1 basis point, nothing actually, 4.2. Dollar index, though, made a move higher to about 98.5. That's about 0.26% up. And oil prices are near, I mean, actually almost flat and unchanged at around $66.5 a barrel. In terms of news flow, again, it is very, very thin. So President Trump has signed an executive order extending US-China trade tariff truce by another 90 days. This was widely advertised, expected, etc., etc. So, I mean, basically, it's just happened. There was a press conference which President Trump addressed from the White House and took questions, etc. It was about, of course, Washington, D.C. and what he wants to do there with regards to policing and sort of, you know, getting federal forces as far as Washington, D.C. goes. But, of course, there were questions about tariffs and actually there was one about India, but nothing really new in that sense. On Russia-Ukraine war, and this is the big cue that I sort of highlighted right in the top yesterday morning as well, which is the meeting between President Trump and President Putin, and he confirmed that the meeting is going to take place on Friday. He said that he will talk, President Trump said he'll talk with Ukraine and Europe after he talks with Putin on Friday. So, I mean, you know, a lot was said about it, but can you really take away a strong, solid thread from it? This or that? Not really. But the meeting is taking place, so that kind of sort of keeps hopes higher. I'll just quickly come to the levels because there's not very much else sort of noteworthy with regards to global markets. So yesterday, both the Nifty and the Nifty Bank had a decent move, and we've managed to close above the 40-hourly exponential moving average. Nigel will talk more about this, but I looked at the positioning data, which is nothing but FIIs in index futures. Short positions have not meaningfully moved. I think there were about 1.82 lakh contracts short as of Friday's close. That number has moved a little bit to about 1.78 or so. But there's other stuff there which we will address. So there is, I mean, you know, FIs are still heavily short. That's the point. And there is room as you go into that Friday event, perhaps for a little bit more covering. Hopefully, that was what I sort of thought yesterday morning. I didn't expect it'll be, I mean, a big move yesterday itself. I thought over the next couple of days, because Friday is a market holiday, you get a bit of a lift. Nifty resistance on the way up now, 24,634. And then the 24,847 mark, which is nothing but the 20-day moving average, which is the 24,847 level. Support for the Nifty comes in at the low, which is 24,337. For the Nifty Bank, it needs to close above the high of 55,652, which is nothing like but the Nifty at the recent high. And then the 20-day moving average comes into view if we get past that, which is 56,213. So, you know, that's the overall broad setup that we're working with. GIFT Nifty, I don't think, has got very much by way of a cue, an indication, inclination. It's done about 27, 30 odd points lower with regards to the indicative open that it is telling us. Survey.
Yeah, absolutely. Actually, cues are thin, global as well as local. So not starting with too much of heavy news flow, which could be actually a good thing for the market. If you're looking at the Asian region, obviously, markets are reacting to the fact that China has indeed scored this 90-day extension. It was widely expected. So therefore, you're not seeing any dramatic moves. Minor gains on the Hong Kong Hang Seng. Actually, it's very flat now, not even 1 point higher. The mainland Chinese market is doing better. Shanghai Composite is up about 0.5%. Taiwan is seeing some gains for the time being. The big rally this morning in Asia is in the Nikkei, the Japanese market, 2% higher. Japanese stocks are ripping ahead, led by names like SoftBank. SoftBank has been on a 5-day tear, and that is continuing. Then, a bunch of other stocks, Mitsui, etc. All of them are looking very, very good. The Australian market also hit a record high today. It's anticipating a rate cut from the Reserve Bank of Australia, so rate action in focus over there. So generally speaking, Asia is looking quite okay, which is not what the implied open is suggesting for us. So let's see what actually happens. Yesterday, the bulls finally got a reprieve, a breather after many sessions with a rebound from largely oversold levels. Now, can the Nifty build on to an advance above 24,500? We'll see. The flows picture. Domestic institutions, as usual, on the buying side, almost 6,000 crores of buying came in. Obviously, there was, large blocks as well that skew the data. But net 6,000 crores of buying from the local institutional side. FPIs, again, after being buyers on Friday, Monday, yesterday, again, they were on the sell side. Sold off cash equities of worth almost 1,200 crores. As I said, not too much of local news flow. We'll talk about, of course, the ending earnings. And many of them are, still lackluster. Bata, for instance, just an example. Soft. Once again, the top line has been weak, but there is some margin expansion year on year, so we'll see how the market reads into it. Tilak Nagar continues to be a very solid set. Clearly, no consumption issues over here. 30% kind of growth, and the stock's done well. That acquisition has been the big talking point as well. So watch out for some of these names. And aside of earnings, Indian Hotels has announced, a small acquisition, buying 51% stake in A&K Hotels for 110 crores and 94 crores for a stake in Pride Hospitality. Now, these are companies that run the Clark's group of hotels and resorts. So we'll see. Largely, the stock has done really well, and the market is positive on hospitality as a space in any case. So this remains a watch point as well. But Nigel, you tell us, what are you tracking?
Well, the Nifty yesterday, as we had hinted, that it bounced from oversold levels. Whether you looked at the PCR, you looked at the shorts, you looked at the RSI as well. That was calling for a bit of a bounce, and that's precisely what happened in yesterday's trading session. Follow through, though, is going to be extremely important. Remember, last week as well, we had a bit of a bounce, but we didn't see follow through. Now, this time around, let's see whether or not the bulls actually can drive home the advantage, because we've got a shortened week and you have big global cues as well that are lined up. Now, moving to for the markets on the whole, yes, there was a bit of a short covering bounce. The Nifty bank ended higher. And for the market on the whole, there was some covering because the open interest was lower. But you look at the FIs, well, very mild short covering is what we saw. If the markets can get a hold of themselves, if we can get some kind of positive news flow, imagine if we see a bigger short covering bounce, because yesterday it was only around 2,800 contracts that were covered on the short side, while even on stock futures, well, there was some long addition and there was very mild short covering. The short point is yesterday's bounce was not entirely short covering, because the FI shorts, they're pretty much still holding onto their ground. And as you see in percentage terms as well, it's around 91.5%, which is at a very elevated level. In absolute terms, the clients as well as the FIs, they have been on opposite ends, and that continues to be the case. 1.2 lakh contracts on the long side for clients, while FIs, they are short at around 1.8 lakh contracts. Moving to the PCR, we had highlighted this yesterday. At around 0.65 odd, you do see a bit of a bounce. That happened. But now the PCR has moved back towards the midpoint, which is at around 1. That's because yesterday's trading session, you had two strikes that were very active. 24,500 put, 24,400 put. Between them, they added close to around a crore shares, with the premium as well coming down. So these put writers, they feel they're back in the game. Which brings us to the levels that we're looking at. On the downside, the 24,350 mark, that's extremely important support. I'll tell you in further detail in just a bit. Resistance comes in. First level of resistance, 24,750, and then all eyes are on the 20 DMA. But the reason I say that 24,350 level is extremely important on the downside, because the last few trading sessions, the lows of the day are in that vicinity itself. So that's the important mark. You don't want these levels to get violated on the downside. One other positive in yesterday's trading session was after many trading sessions, the Nifty made a higher high, very mildly so, but that was good because for 7 straight sessions, we had lower highs that were being made. Which brings us to the Nifty Bank. You know, yesterday it did bounce off that 55,000 odd mark. It saw a bit of a bounce, but now we have the 20 and the 50 DMA. That's the resistance mark, which is close to around 600 points away from current levels. So you'll want the Nifty Bank to gradually move towards that level. And since Donald Trump has given a bit of an extension to China, well, I'll keep an eye out on the metal stocks because normally it has a bit of a positive rub-off since he's extended that for close to around 90 days. So short point being, yesterday was a good trading session from extremely oversold levels. You want to see some follow-through level. You want to see the Nifty go ahead and conquer the 24,750 odd mark.
All right, Nigel, thanks very much for that. So that's the setup as things stand right now. James Knightley is with us, Chief International Economist at ING. He's with us. James, good morning. Great to have you with us on the program. Thanks for joining us. Just a quick word, James, on, what can we expect? I mean, I think, trade and non-trade stuff, geopolitics, it's all kind of sort of mixed in. If you want to sort of identify this one big dominant driver for markets, I don't know if it is really trade and tariffs or if it is it geopolitics on Friday. What's your sense, James, if I can sort of ask you a slightly open-ended question?
Yeah, it's there's lots of things in play right now, aren't there? As you say, geopolitics, trade, and of course also we're looking at the Federal Reserve. I think there is a lot of hope and expectation in the United States markets that the Federal Reserve will be able to come in, offer several rate cuts, get some stimulus into the economy, get the economy firing, get corporate profits firing again as well. So I think those are the three factors that we're all really looking at, and that's why I think today's inflation numbers are so important.
Okay, James, hi. Good morning to you. For the US market itself, I mean, so far data has been extremely strong and buoyant, right? Now, as the tariff collection has finally begun, what do you forecast going into the towards the end of the year? What sort of an inflation increase would you expect in the US?
Yeah, well, I think, when we look at the growth backdrop and the inflation backdrop, I mean, at the start of the year, there was a lot of optimism about the US economy, the expectation that it would grow about 2.5% this year. Expectations were that Donald Trump would focus on tax cuts, focus on deregulation. And of course, he hasn't done that. Instead, he's focused on immigration controls, he's focused on tariffs, and he's focused on government spending cuts as well. So very different policy mixes. And that's why we've seen the consensus growth forecast for this year really be cut quite significantly from that 2.5% at the start of the year down to about 1.5% right now. Now, also, inflation has gone the other way. Inflation was expected to converge on target, but now, as you say, these tariff-induced price hikes that we're anticipating, some early evidence of that in June. We're expecting more of that in today's July data. Well, we think that can push inflation probably close to 4%. But that's not going to be a sustained story. We're in a very different economic environment to 2021, 2022, when a similar sort of goods supply shock, i.e., the COVID pandemic supply chain strains. Today, we've got the tariffs. Well, that was really amplified back then by a tripling of the oil price, by a red-hot jobs market pushing up wages, and of course, house prices in the United States rising 50%, driving rents higher. We don't have any of those factors this time around. So I think, we'll get inflation a little bit higher, perhaps close to 4%, but we'll certainly be falling again before the end of the year, and I think falling quite quickly through next year, and that will allow the Federal Reserve to come in and cut rates pretty hard.
All right, James, the last time we spoke, you were a little bit hesitant with regard to the Fed cutting rates. But now going by the softest data and going by what we're seeing on ground, you believe that, maybe 2 or 3 rate cuts could be done in this year itself?
Yeah, we've got to remember that the Federal Reserve is different to most other central banks. Most central banks in developed markets target inflation at 2%, and that's their one job. The Federal Reserve has that, but it's also got to maximize employment as well. And of course, the jobs numbers that we got in the most recent report were subdued, were pretty weak, but it was those 250,000 downward revisions to the previous 2 months of data that really jolted the Federal Reserve. I think, the narrative from Jerome Powell, the Fed chair, had been that the jobs market was pretty solid, the economy was pretty solid. Well, when you've had 250,000 downward revisions to 2 months, and the subsequent story tells us that hiring is concentrated in just three sectors of the economy, private healthcare, leisure and hospitality, and government, well, that doesn't signify a robust, solid economy to me, and certainly not to the market, and certainly not now to most people on the Fed. So I think that change in story on the US jobs market really does open the door to those interest rate cuts from the Federal Reserve.
I think, and later today, we have the CPI numbers, right, James?
Correct, yeah.
Yeah, so we'll see if that is important. So it'll be a good question.
Yeah, I was just wanted to sort of round it off by asking James for a view on how you're seeing India amidst this tariff turmoil. And very clearly, I mean, we've got one of the worst deals along with Brazil. But then we're not an exporting economy. But a lot of people are talking about second-order potential effects, James, with whether it's fund flows, FDI flows, business confusion, etc. What is your assessment of India, given this tariff standoff as of now?
Yeah, I mean, we've got to remember, I mean, most countries, and India is no exception, do not rely on exports to the US for their growth. Even in Europe, where it is seen as more vulnerable, exports to the US account for barely 4% of total, economic activity. And this is all really quite manageable stuff, especially if you've got offsetting growth from elsewhere. So yes, it's a hit to sentiment. It's a creation of uncertainty. But it can also be a trigger for opportunity. And certainly in Europe's case, for example, we have seen government politicians look to take advantage of that and are driving and striving for their own economic policy away from the United States as well. So it may well help India in terms of diverging and looking for alternative trade partners as well.
And that's exactly what our colleagues in Delhi are picking up. Those overtures have already begun. In fact, yesterday we did report that, for instance, there's a greater cooperation that will be now forged with a lot of other markets, including Africa and the Middle East as well. So let's see how these alignments shape up. Thank you very much, James. Great conversation with you this morning. Thank you for joining in today. Well, let's tell you what else we have lined up for you over the course of the next 2 odd hours. At 8:35, the management of Awfis Space Solutions will be joining in to discuss their quarterly performance with us. At 9 a.m., we'll have Praveen Sahai of PL Capital to talk about the sharp fall in AC stocks, the road ahead for the consumer durables sector. At 9:20, Amish Shah of Bank of America Securities joins in. He's our market master of the day, so we'll get their house views. At 9:30 a.m., we'll be speaking with the management of BSE, talk about BSE's quarterly performance and the path ahead, considering lots of regulations are still being spoken about. After that, we'll have A. Balasubramaniam of Aditya Birla Sun Life AMC joining in to talk about the stellar equity inflows that we saw the mutual fund industry draw in July. And towards the end of the show, in our special segment, It's the Economy, Lada will be in conversation with former Deputy Governor S.S. Mundra and Bernstein's BFSI expert Pranav Gundapalli on the impact of ICICI's sharp hike in minimum balance in its savings accounts.
We'll take a short break. We come back, we go full throttle on stocks that we're tracking for you in our special Top 10 segment. For the time being, I'll run you through the list. Indian Hotels and Tilak Nagar Industries will react to positive news flow, while we have way more number of stocks that are part of our top 10 that will be reacting to negative news flow. Hindalco, Dr. Reddy's, Auto Pharma, MediAssist, Bata, Astral, Praj, and Titagar Real Systems. All of them will be reacting to negative news flow. We take that break, come back, get into further detail on all of these names.
Welcome back. Well, it's quiet cues as far as the implied open is concerned, though Asia is looking at a pretty decent rally, but it doesn't seem to be rubbing off on us here. I mean, the other markets I'm talking about, mainland China, Japan doing really well today. Implied open about 7 points lower. Let's see if the bulls can actually build on their good form from yesterday. There are plenty of stocks to go over as well. Last of the earnings coming through and an acquisition by Indian Hotels. So let's straight away get to our list of top stocks to watch. Nigel, kick it off. Hindalco, how do the numbers look?
Well, Hindalco, will be in focus because Novelis came out with its set of numbers. So we'll analyze that. And later during the day, we'll get the India business numbers. Now, Novelis's numbers were softer than expected. The EBITDA per ton came in at around $430 per ton. The street was bracing for a number of around $450 per ton. Why is that? Scrap prices were elevated. That's point number one. That's the input cost for them. The product mix itself was not that great because the demand for cans was good, but unfortunately for specialized products wasn't that great as well as auto. And also the tariff impact is clearly showing up. So the shipments were up by close to 100%, adjusted EBITDA was down 17%, and on a per ton basis, it was down by close to around 19%. The tariff impact they've quantified for the past quarter, it was around $28 million. And since we don't have a breakthrough, they're bracing for a $60 million impact in quarter two itself. And the chart should come up for you. The EBITDA per ton, well, it's come down to close to $430 per ton. That's down from around $490 per ton. Even in absolute terms, well, it's down to around $416 million. So the EBITDA performance, both on a per ton basis as well as on a absolute number, that did dip. But management is sounding optimistic about things improving from here on. They're calling for a bottom on EBITDA in the first quarter itself. They're saying because of the cost-focused measures, things will improve, particularly in the second half of the year. And in terms of the cost saving, they are now guiding for $100 million. What adds to the pain is that the net debt number as well has moved up marginally, and it's at the highest we've seen in the last 19 quarters. So weak set of numbers coming from Novelis. The only solace is that the management is calling out for bottoming out of the EBITDA number. So expect a tinge of red on that particular stock. Moving to Ekta, she's here to tell us about Dr. Reddy's as well as Oro Pharma. Ekta?
Well, yes, a couple of these pharma stocks, in fact, are going to be in focus because the US drug regulator, the US FDA, has approved 2 generic versions of the drug iron sucrose, and it is approved by Viatris and Amphstar. So those are the companies which will be able to sell the generic version of iron sucrose in the US market, and both may be eligible for 180-day exclusivity. Now, iron sucrose, remember, is an important pipeline product for the likes of Dr. Reddy's, Aurobindo, Sun Pharma, Gland. All of them were vying for this particular product, but now 2 other companies have entered the market. The market is around $500 million. What this means is because no Indian company has received approval for it, then maybe it could be a dwindling opportunity, a lost opportunity if in case the approvals do get delayed, and hence we could probably see these stocks a bit in the red on account of this.
All right. Thanks very much, Ekta, for that. So keep an eye out on those names. Indian Hotels is the next one. Vinny's got details here. Vinny, morning.
Good morning. So yes, keeping an eye out on Indian Hotels, we're expecting green coming in for the stock today after the company has acquired 51% stake in ANK Hotels as well as Pride Hospitality. This is for around 204 crore rupees. Now, what this will do is this will add mid-scale hotels to Indian Hotels' overall portfolio, and this is expected to be completed by November 2025. In terms of overall strategy, also strengthening its presence across geographies and mid-scale segments, expanding its portfolio by 135 hotels, as well as this is aligning with the strategy that Indian Hotels has of asset-light growth is what they want to focus on. So that is something interesting that is coming in there in terms for the acquisition from the company.
Okay, all right, got that. So Indian Hotels will be on our radar. Well, as usual, expecting some more blocks. We have Nimesh joining in with what the action today could be like. Nimesh?
Well, Surabhi, another day, another large block. So there is a clean-out trade in Medi-Assist. One of the promoter entity, Bessemer India, is looking to sell its entire 15.7% stake via block deal today. The floor price is 507, which indicates a 4% discount to yesterday's closing price. Interestingly, after this block deal, the total promoter holding will fall to below 5%, and the institutional holding can go up to as high as 75%. So a large block could open in the red if it's not in the block window. But the interesting point is that the promoter holding will fall below 5% after today's block.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's go to Vinny. She's here to tell us about Bata India. Vinny, it's not running away.
Yes, it's not running away. Soft quarter again that's coming for the company. Now, overall, EBITDA also this time has been a bit muted. Lower other expenses is what has come in for the company. Though optically you see and you'll feel like the profits are lower because there was an exceptional gain last time. But other than that, what you're seeing coming in, flattish revenue growth, 9th consecutive quarter of revenue growth that has been subdued for the company. The average selling price that we're looking for the company has also been very muted and declining for the 3rd consecutive quarter. So overall, demand hasn't been exciting. Weather was not something that was supporting overall Bata sales as well. And one more weak quarter and subdued quarter for the company is what we're seeing. We could expect red on the screen for the stock.
All right, Vinny, thanks very much for that. Astral is the next one we want to focus on. Ria has got details on this one. Ria, morning.
Well, good morning. Astral has reported quite a weak set of numbers in Q1 of FY26. Revenue lower by around 1.5%. The EBITDA and net profit have taken a hit of around 14% and 34% respectively on a year-on-year basis. Margins have also declined by around 191 basis points. Even if you look at the individual segments, the plumbing business and the paints and adhesives segment of the company, the margins have fallen quite a lot for each of these segments. Volumes for the plumbing business are largely stable at around 56,000 metric tons. Now, commenting on these results, the company has said that overall the demand scenario in the polymer industry was weak in this quarter, and that the PVC price volatility that we've seen over the last few months has resulted in inventory losses and also affected the realizations. But going forward, what they've said is that PVC prices have actually been seen settling down since the beginning of Q2 of FY26, and market conditions have also been seeing some improvement. So the outlook remains positive for the quarters ahead. And another bit of news flow to keep your eye out on, they've also approved the proposal for the acquisition of an 80% stake in a company called Nexalon Chem Private Limited, and this will be done to manufacture CPVC resin, which is a key raw material for the company, and it's expected to help in cost optimization for the company as well as a substantial margin improvement once the operations start from the second quarter of FY27.
Okay, all right. So positive commentary coming in from Astral there. Thanks for that, Riya. Let's move across and go to Vamakshi. Vamakshi is looking at Praj Industries numbers. Morning, Vamakshi.
Good morning, Surbi. Not such a great set for Praj Industries. The revenue dipped by almost 8% on a year-on-year basis. The EBITDA margin contracted by almost 825 basis points, given that operating expenses actually rose this time around, and the EBITDA contracted by 66%. Take a look at the net profit as well. A 94% cut is what we're seeing as far as the net profit is concerned. But also keep in mind that this could also likely be because in Q1 of FY25, there was an exceptional gain of around 28 crores, which was on account of a profit of a sale of land. But even accounting for that, there is definitely a fall in the net profit. As far as segment-wise revenue is concerned, bioenergy, which is one of the largest segments for Praj, saw a dip of almost 24%. On the other hand, this was offset by a 29% jump in engineering and a 41% jump in high purity. Now, this time around, the performance was impacted on the back of a couple of factors. First off, the domestic ethanol business witnessed some delayed execution cycles as well as liquidity crunch. This was mainly on account of the problems at the customer's end. The GenX business incurred expenses with no corresponding revenues, and of course there was delayed execution of a couple of high-value engineering orders, which led to higher labor costs as well as infrastructure costs. The ordering activity too dipped by almost 11% this time around. So given those details, not such a great set coming in for Praj Industries.
Okay, all right. Thanks a lot for that, Vamakshi. Well, let's go back to Vinny. Very busy morning for you. You're tracking Titagarh Rail as well as Tilaknagar Industries. No slowdown there. People are tanking in the brandy.
Absolutely. But first, let's talk about Titagarh Rail. That stock, we're expecting a muted performance that we saw in Q1. So red is what we could see on the screens. Now, revenues are down by around 25%. EBITDA margins down by 27%. Margins have seen overall contraction as well of around 20 basis points, more than that. Now, what is impacting them this time is the weak performance that's coming in the freight railway system segment of theirs. That has seen a contraction of around 27%, and that is dragging the overall revenue growth of the company. Now, in terms of wagon dispatches, also that has been weak in the railway wheel factories, and that is the reason why we're seeing lower growth coming in for freight railway systems. So, company and management is saying that they're confident of recovering the loss in by the end of this year. Production has started normalizing by the end of this quarter as well. So that will be interesting to watch out for. Wheel set supplies by the end of July have normalized, so not much of a concern that we could see coming in Q2 FY26. And they're expecting FY26 to see similar offtake in terms of wagons as we saw in FY25. Now, talking about Tilaknagar Industries, great set of numbers that's coming from the company, doubling in terms of profits. 88 crores is what the profit is at versus 40 crores last year. Good growth in terms of revenues. Margins are at a multi-year high as well, 23.1% versus just 16% last year. So clearly a good number that's coming from Tilaknagar, and green is what we could see today.
Absolutely. Starting the year on a high. That's Tilaknagar Industries. Got it, Vinny. Thank you very much. So let's quickly recap our list of stocks to watch. The ones that have positive news flow around them this morning: Indian Hotels and Tilaknagar Industries. That's 8. And then you have 8 on the red side today, including Hindalco, Dr. Reddy's, Oro Pharma, MediAssist, Bata, Astral, Praj Industries, and Titagarh Rail Systems. So a mix of slightly weak earnings and some negative news flow from the US FDA for the pharma companies. Okay, so that's our top 10 list for the day. Let's look at what's happening in the world of commodities as well. Manisha is joining in as always. Morning, Manisha. So tariff, non-tariff, this whole gold business. Finally, it's not tariff, right? That's the final verdict from Mr. Trump.
Well, yes, a formal, proper notification is yet to come. But then U.S. President, when he tweets saying gold will not be tariffed, you understand that. And that's the reason you've seen the gold prices decline so sharply. We did see an all-time high at 3,530 on Friday. It's trading at 3,350 right now. So we are down $250 an ounce from those kind of levels there. And overnight as well, it has been another 1.5% of a cut coming into the market. So this clearly is easing fears of sharp rise in gold import costs. And that is what the markets are working with. Also, apart from that, the U.S. signing an executive order extending pause on U.S. tariffs on China for another 90 days also has led to no more safe haven buying when it comes to gold and silver as well. Silver, by the way, fell nearly 2% overnight. So we're looking at huge profit taking in all these precious metal commodities. What is doing well actually has been the crude oil prices. After that 4.5% decline in the previous week, we're looking at some stability coming back. U.S. has signaled that there would be no new sanctions on Russia crude until the talks continue. So that is what the markets are reading in right now, and that is what has led to some support across metals as well. So copper, steel, iron ore, all trading in the positive.
Okay, all right, got that. Thanks very much, Manisha, for the update. We'll take a quick break on that note. On the other side, we have the management of Awfis Space Solutions joining in to discuss their quarterly performance and, of course, the outlook for the rest of the year. And after that, we'll have Amnish Agarwal joining in for some fundamental stock ideas.
Well, Awfis Space Solutions is a stock on our radar. The company posted a strong performance actually in Q1. Strong revenue growth, improvement in margins. Let's talk in detail about the quarter gone by and the way ahead. Mr. Amit Ramani, the chairman and MD, joins us on the show. Hi, Amit. Good morning. You're walking the talk. Solid set of numbers. Give us a few details. What was the seat addition in the past quarter? Could you tell us for the year as well? What is it looking like? And how much of it, in the past quarter was via managed aggregation?
So, Nigel, the seat addition has been fairly strong. We today sit at about 232 centers. 155,000 seats is the total. And we have another LOI signed of another 10,000 seats, which takes it to about 165,000 seats and roughly about 13 additional centers. So 246 total centers is what we are targeting. The seat addition for this year, same as last year, we are targeting about 40,000 seats to be added. This year, we have clear visibility of about 30,000 right now, and another 10,000 we will add over the next 8 odd months.
Okay, all right. So by the end of this year, we'll be around 200,000.
No, so by the end of this year, we'll be 175,000. 175 at 135. And,
all right. So you've added already 15. Got it.
The ratio remains the same, which is 65-35 split. So 65% is managed aggregation, 35% is straight lease.
Okay. Mr. Ramani, so, can you tell us how the year is looking in terms of overall EBITDA margins, etc.? Are there any renewals coming up where you would hope to renegotiate those leases higher? And just give us an update on the GCC side of the portfolio as well.
So I think EBITDA improvement, as we had given the guidance earlier as well, I think will remain almost along similar lines. So if I look at the current quarter, we were at about 37%. So I think it would stay in that range for the remainder of the year. In terms of the GCC portfolio, the mid-tier GCCs, which is the first-time entrants, I think has seen a large growth out of the 50-odd GCCs that came to India over the last, I would say, 9 odd months. About 9 are with us. So I think a very, very strong part of our portfolio. These companies include Meltwater, ABC Fitness. So I think we feel that that is certainly an area where we see a great potential and large growth. If you look at last 20 years, there were some 1,500 odd GCCs. In the last almost 12 months itself, there's 200 plus GCCs that have been added. And I think the prediction is very strong to be about 2,600 GCCs in the next 4 years. And we obviously want to play a big part in that growth journey.
Amit, hi, morning. But you know, the larger companies, American multinationals, etc., who come and set up their captives here, I mean, they typically they'd want their own infrastructure. I mean, entire facility sort of leased out, kind of model. That's what we've heard from consultants, etc. We've spoken on this.
Right.
Or
the
is it,
GCCs that are already established in the country or already have a presence, they would like to do their own, obviously, leasing. But from our standpoint, as you are aware, we do a design build service, which is a fit out service. So they clearly engage us for those kinds of services. And that's already happening with a couple of our clients where they have done the lease, but we are doing the design and the build service for them. So clearly, I think we play a role there as well.
So you will, I mean, you do the fit out, etc., design, fit out, etc., and then you do the maintenance as well.
No, in many cases, they essentially hire us for doing the design and build. We do the build out, and then we basically walk away. They do their own maintenance.
So it's like that would be like a one-time revenue stream in that situation, right?
That is correct.
I just had one more question. You know, your business, I'm assuming, office space is linked to the economy, right? I mean, and whether the economy is the margin, it's all relative, of course. I mean, slows, picks up pace, etc. Over the time that you've operated the business, how sensitive is your business, the office business, to this? Because there seems to be a little downward pressure, not just here in India in terms of growth, but globally as well. How sensitive is it? Or you think the more important trend is, you know, cost efficiency, cost savings, which corporates are looking for, and that move will more than offset any growth slowdown?
So if you look at the industry, you know, in 2020, March of 2020, this industry was about sub 20 million square feet. Today, we are touching almost 80 million square feet. And the projection is in the next couple of years, we should cross 100 plus million square feet, right? The industry is growing at about 20% CAGR. It's almost 20% of the total commercial leasing. 80 million square feet was the total leasing last year. 16 million was flex, as we saw. So I think very, very strong trends. And I think it's a behavioral change that has happened. I think corporates, the large corporates look at it for flexibility and speed, and obviously distributed work where they want to set up maybe, you know, sub 500 seater centers. But the mid-tier and obviously the SMEs for sub 250 seats, I think this is a behavioral shift. And this will continue, I think, for the long term.
Sure. Mr. Ramani, just to go back to that point, like you were explaining to us that you do provide these fit-out solutions for large GCCs, and that becomes a, you know, revenue stream in itself. Like that, you have a lot of other allied services as well. I think you're looking at cafeteria management, there's mobility. So give us a view on all of that. How much do they contribute to your overall revenue today? And where will that number be, say, a year or two down the line?
So last year, this contributed roughly about 11% of our co-working revenue, right? Because that's where this service is part of. So which was roughly about 100 odd crores out of the total 1,200. This year, the target is to be about 155 crores, which would be roughly about 15% of the co-working revenue. And we feel that this area has tremendous growth. We would like to make it grow, obviously, you know, closer to about 20% over the next 2 to 3 years. And clearly, I think the offerings that we have added, which is food and beverage cafeteria management, which we do for third-party independent, the mobility solutions, which is day passes and virtual offices, and in addition, our office tech labs. And also, we are launching our furniture business as well this year. So I think all of this will start contributing a decent part of our overall revenue. As I said, roughly the target this year is to be about 15%.
Okay, and total revenue CAGR with all of this kicking in, I mean, the first quarter you've done really well, 30% growth. So just a CAGR over the next, say, 2-3 years, top line, what would it be?
I wouldn't comment on 2-3 years, but clearly the guidance for this year is we will do about 30 odd %. And I think we are well on track for that.
Okay. All right, we'll leave it on that note. Thank you very much for joining in, and good luck for the rest of the year.
Thank you,
That's Awfis, and everybody is going to Awfis, and seems their business is doing well.
You have now, in quick order, you have 4 listed businesses in this space, right? Smart Office is one. There's Office, of course, the older one. There's one more, which just came to the market, right? So I think at least 3 listed
And then we have
co-working businesses.
Yeah.
And I think there is one more coming, which is, I don't know the name, but I think there's one more in the pipeline, which is going to, and that's the largest, by the way, which is...
Are you talking about, but that's the REIT, the Knowledge Realty Trust.
No. The next REIT is the
Knowledge Realty
Bangalore,
Trust, which is the Blackstone one.
Blackstone and the...
Yeah.
I think there's another co-working sort of company coming to the market.
We'll get into it. We'll look it up. But let's quickly bring in Amnish Agrawal into the conversation as well. Amnish, good morning. Lots of stocks to discuss. Plenty of numbers have come by. Most have been, weak to lackluster. Bata, Praj, Astral. Nobody's lighting up the charts. But you tell us it's all about looking forward, right? Now, this quarter is over and done. Among some of the names that I mentioned, which have all reported in the last 24 hours, would you look at buying anything? Would you look at buying into the weakness for either a Bata or a Praj, say?
Okay, hi. So, I think we need to look at objectively that 1Q had few disturbances, like, for example, few days of sales were lost everywhere due to operations improved. Then we had early monsoons. And to that extent, I think 2Q in general should be better for the industry because we have early festival season starting this year. But having said that, I think one also needs to look at what happens on the, you can say, the tariff front with US. Because the inflation is already down, monsoons are normal. So if you look at broadly, the domestic part doesn't look bad unless and until due to some global geopolitical issues or something, there is some global impact on demand and there are some job losses due to that. So as far as these particular stocks are concerned, I think one can't paint them with one word. Say, for example, Parag from last couple of quarters, it has not been doing well. Its new facility, I think they were hoping a lot to export to the US. So I think one needs to wait and watch that what sort of a ramp up which happened at the new facilities. Similarly, if you look at, say, Astral, the demand in the plumbing side has not been that great. There is some sort of, I would say, a slowdown. And it is, pipes has been, you can say, average for them. But the stock definitely from the peak, it is significantly down. So maybe I think in the near term, the visibility on some of these names, it remains slightly hazy unless until one takes slightly longer term view in this.
All right. Hi, Amnish. Good to see you. Prashant, by the way, another smaller company is EFC, which is into the similar space. It's been a big wealth creator as well. And now we have a lot of mutual fund participation as well in that counter. Amnish, any view on this space? Awfis, we just had the management. Any comment on that? What do you like?
You see, I can't give you any stocks for that, but nonetheless, I think with the GCCs growing well in India, and practically now the growth in GCC is far, far higher than IT services, which we had seen over the last couple of decades. And the general, there is a trend that people want to go into co-working spaces because of the, I would say, the low capex involved and some of the other benefits which they are having. I think this space holds a lot of potential. But having said that, a lot of it will depend upon the, I would say, how the current situation around whether it is tariffs, whether it is around, you can say, doing multiple deals with, you can say, various countries on that. I think in the longer term, the space definitely holds a lot of potential. But one will also have to be cognizant of the valuation because some of these stocks today are trading at quite a good, I would say, premium over the general market.
Okay, all right. Let's talk about Hindalco. Novelis's numbers were expected to be weak. They were weaker than expected. But going by the management commentary, they are saying that they believe now the EBITDA has bottomed out. And that's taking into account that the tariff hit in the first quarter was around $28 million. For the second quarter, going by the current tariffs, it could be in the vicinity of close to around $60 million. What would your view be on the stock if it opens lower?
You see, in general, one has to look at that. You see, Novelis is an important part, and now U.S. tariffs are actually a reality. Whatever one might think, whether they will go back to where they were earlier for any country, practically that is something which is very difficult to say at this point of time. So there could be, say, some sort of volatility due to that, but the practical thing also is that if you want some consumption industries to be there in your country because US has got very limited production of lot of stuff, then definitely you will have to make some adjustment. The prices have to go up. So after the knee-jerk reaction, usually the stability comes, and that will also be reflected in the, you can say, the margins of some of the companies which are operating in US. Because in US, I think everyone who operates there, who manufactures there, so people have been passing on the costs to the consumers. So I think based purely on this economic logic, I think the margins definitely, I think they would have bottomed out, or they will bottom out in most of the cases in another quarter. And I think after that, it should be more steadier than what we are witnessing or what we might witness in 2Q of this year.
Got it. All right. Amnish, I'll tell you what, I think we'll just take a short break. We'll come back. We'll continue our chat with Amnish, and also we'll get in our technical experts. Mitesh and Sudarshan are waiting for you on the other side.
Welcome back. There's 9 minutes to go for the pre-open session. Sudarshan Chukani and Mitesh Thakkar are with us with what they want you to do. This is 0.6 point change on the as far as the implied open is concerned. So absolutely flat. Can go in either direction. I think the Mediasis large deal has gone through. 1.1 crore shares have changed hands. And that's a deal worth nearly 600 crores at about 523 rupees per share in the block deal window. That's about 16% equity, which Bessemer has sold. And we'll, of course, later try and get a sense of who the buyers on the other side have been. But it looks like it's gone through without a problem. Sudarshan and Mitesh are with us, as I said. Gentlemen, morning. Mitesh, you go first. How are things set up after yesterday's 200-point move?
So I think, to me, looks like a case of a strong bounce back, and we could see a bit of extension. The GIFT Nifty is, of course, indicating a mild gap up as well. But the level which I highlighted yesterday, that was also around 55,750 or thereabouts. There could be another about 150, 160 odd points to go from here. That's where you need some moving averages on the charts, and therefore that should be the first target. We still haven't got a conclusive reversal sign on the daily charts. Some intraday charts have turned on the upside. So I think I would presume that around 24,750, 800 zones, you will see some good profit booking coming in. So if people have long positions, I think that is the zone people should look to take profits out.
Okay. All right, Mitesh, got that. Let's also ask Sudarshan whether he'll take a trade on the indices today. Sudarshan, what did you think of yesterday's 200-point rebound?
Yeah, good morning. Well, it was welcome. And the markets were oversold, and it was a question whether we would bounce back. We did. So the trade is very simple. If you are an intraday trader, today also you look for some dips to take an intraday trade. I would not suggest carrying any positions. The date when we want to carry positions is Thursday. When we have an extended weekend, there is a reasonable amount of risk and a very decent reward that would emerge that day. For today, take intraday trades on the long side. Do not carry any positions.
Okay, got it. Don't carry any positions. Sudarshan, what about stock specific though? You'll have a few ideas for us?
Well, yes, usually, the stocks are mainly on the buy side, and that happens today also. Zydus Life is a buy with a stop under 936. PFC is a buy with a stop under 411. ONGC is a buying opportunity with a stop under 229. And Supreme Industries is a buy with a stop under 4260. So there are 4 mid caps, all for buying.
Sudarshan, thanks for that. Mitesh, what about you? What are your trades?
I have buy calls too. A buy on L&T with a stop at 36.40. And here I would look for targets of around 37.30. Policy Bazaar is a buy as well. Keep a stop below 18.38. Look for targets of around 19.10. Buy on Biocon. Now the stock has corrected from 400 plus levels to about 335, 330 zones and is bouncing back. So a short-term bounce back trade can take place here. Buy with a stop at 337, exit around 355, and Colgate-Palmolive is the final buy call. Buy with a stop below 21.94 for targets of 22.55.
All right, Mitesh, thanks. Sudarshan, thanks for that. We'll come back, speak with you at 9:10. Take a quick commercial break here. We're going to come back in just a bit from now. Praveen Sahai of PL Capital also joins in on the other side. We talk about the sharp fall in AC stocks, Amber, Voltas, PG Electroplast, of course, and the road ahead for consumer durables in general as well. Stay tuned. Welcome back. There's 16 minutes, 15 minutes and 50 seconds to go as far as the market open is concerned, and about a minute to go as far as the pre-open session is concerned. We've been, of course, talking about what is explaining India's underperformance, right? I mean, earnings deceleration, of course, is a big one. Valuation still about one standard deviation above normal. Historical averages is another. But I think a lesser spoken about fact, which I alluded to, I think, last week was maybe is the lack of AI stocks. Surabhi, and I think we spoke about it last week, right?
Yeah.
India doesn't have AI stocks to offer.
And the world is obsessed with just AI and more AI.
Yeah. So, I just want to put out some data which kind of talks to this, right? And this is as of end of last week. Look at what the chase for AI exposure has done. NVIDIA is now 8% of the S&P 500. It's the fattest weight for any stock in the S&P 500 since 1981. This is, S&P 500 is the largest index in the world. 500 stocks, 500 of the largest stocks in the world. And a single name, NVIDIA, is 8% of the S&P 500. So actually, if you think about it, and I may be exaggerating to make a point, 5 or 7 stocks make up the US stock market right now, and all of them are AI stocks. So it's just absolutely incredible what is going on. Just some historical context in terms of where these things have peaked out. Apple has peaked at about 7% of the S&P 500 in 2023. The stock peaked out then. During the dot-com bubble, which is the year 2000, Microsoft and GE were made up about 4% of the market, of the S&P 500, right? IBM hit a high of 6% in 1984. But never before and this is data going back 1981, NVIDIA, single name, 8%, beating all these names. And of course, we know the reason why NVIDIA has done so well. It sells the chips, which enables the compute, which allows for all these AI advancements, large language models, et cetera, et cetera. So, I think it's just quite incredible. And, the US market narrative, by the way, also has been that tariffs, et cetera, may hurt, inflation may rise, growth may weaken. But because AI-led productivity gains are going to be so large, it doesn't matter. As I said, the US market right now is 5 stocks, 7 stocks for all practical purposes. So, things may go south, but as long as these 7 names are solid and continue to rise, that's it. Just look at this outperformance. The Bloomberg Magnificent 7 Index, which is basically nothing but 7 stocks, which Bloomberg has created an index of, has outperformed the MSCI All-World Index by 220% over the last 5 years. That's the outperformance. That's not the return. That's just, huge. Absolutely huge. On the contrary, if you look at India, right? Look at MSCI India. MSCI India has underperformed the MSCI World Index by about 20% since last October. And this is the underperformance in India that I was talking about. And hence the question. I mean, it's just a question. It's just food for thought. Just think about what are the AI stocks in India, right? Do you have can you make a list of 5 names, 10 names which offer core AI exposure? I mean, you can say, well, Indian IT stocks do it to some degree, and they're trying to get into the AI thing, etc. But in terms of core AI, I think it's lacking. I mean, you got it in Japan, you've got it in Taiwan, you got it in China, of course, you got it in US to some degree, you've got it in Europe as well. I mean, lithography machines, etc. In some way or form, many countries around the world offer that exposure, but in India, that is missing. And I'm not saying this is the core reason why India's underperformed, but I think it is one of the important factors which is not talked about as much as the broader theme, which is earnings deceleration, valuations, etc.
Oh, absolutely. And then you look at the bare basic numbers here and now, and they hurt. 1-year return in India for multiple reasons, including the reasons that Prashant just alluded. Nifty is flat, 1% return over the last 12 months. S&P 500, 20% return. And NASDAQ, which has a better representation of all these AI themes, obviously, almost 28% return. It's been a tough last 12 months. But anyway, we've still got hope. At least the domestic institutional investors or the DIIs, the mutual funds, they're still using this period of consolidation to build positions in the market. And we'll talk about that a little later on the show. Right now, we're putting the spotlight on the consumer durable space. In fact, I think we'll have Praveen Sahai joining in the next couple of minutes as well. As I think we have him with us now. Okay, we'll get Praveen in a bit. But before we get to Praveen, let me take a question from Amnish on the space itself. Amnish, the concerns are very well documented. This first quarter has been a weak one for companies across the board. The question is, do you buy into this weakness? Would you buy, say, into a stock like PG Electroplast or even a Blue Star? Or would you remain cautious?
The kind of pressure which all the AC companies and durable companies have seen during the current quarter. So that is not something which happens every time. So we had very exceptional circumstances. And it happened a couple of years back also. So some of these products are, I would say, highly seasonal. That is one. So if the season goes wrong, if there is, you can say, earlier rains or something else, then obviously you will get some pressure. But that is something which happens with the entire industry. But if, say, there could be players who gain share, there could be some players who are sitting on too high an inventory. So then that becomes actually, you can say, an issue with the overall inventory situation and with those particular companies. And given the fact that summer season has already now passed, now offloading inventory in 2Q and 3Q is not going to be easy. So without going into any specific names, if any company is, you can say, holding too much of an inventory in the system, particularly in the AC industry, then for them, liquidating them without any, I would say, your collateral cost is not going to be an easy. As far as your broader durables are concerned, we might see some sort of an uptick in demand because of the early festival season, which we are having this year.
Okay. Actually, Amnish, we have Praveen joining in exactly for further details on this. Thanks very much, Amnish, for your thoughts. Praveen, let me ask you this question. Straight away, first of all, I don't know if you have coverage specifically on PG Electroplast. If yes, please tell us what your assessment is of the situation. Whether this is a great opportunity because you've got a 30% cut, 35% cut on the stock, or is it still overvalued? Is it still very hazy in terms of when things start to recover?
Yeah, hi, good morning. So PG Electroplast is not under our coverage. But looking at how the inventory situation in the market, whether it's with a brand or a channel like a retailer or a dealers, and along with contract manufacturers like a PG or Amber, things are a bit difficult, I can say, in the coming quarters at least, because now our the BE norm change is also around the corner, and before that, everyone has to liquidate their inventory. So as a commentary from the contract manufacturers, overall inventory level has been doubled right now. So how that's going to liquidate way forward? A lot of promotional activity need to be done by the brands, which will hamper the margin. And so as for the entire system, Whether if I look at the retailer like IML or Aditya Vision, they are also talking about promotional offer for liquidation of their inventory. So entire channel was filled with the inventory because of anticipation of the summer were very high. So right now I will be cautious on all the seasonal product companies because the major challenge is liquidation of their inventory in the system.
Hi, Praveen. Good to see you, Ben. But there were various reports over the weekend that indicated that there is some kind of a clawback. Is it too small, to get a little bit positive? And from the pack, what do you like? What would you be most optimistic on post the recent pullback?
Yes, so in the seasonal product, there is the two categories which has underperformed. The one is your cooling product in RSC or in the ECD, the fan category. So if you look at the quarter gone by, Blue Star has outperformed even in this declining scenario. That's an industry decline by around 15 to 30% company to company differ. Whereas Blue Star declined by around 13%, which is outperformance. Even in the margin contraction, margin contracted by around 500 basis points for industry, and for Blue Star is on the lower. So I believe they had a first one to realize that the summer were a very tough, cut down their productions, maintain to some extent they had maintained their numbers. So I think Blue Star is well placed in the tough scenario given the good numbers. So I will prefer that. Secondly, on the ECD portfolio, if you look at around 10% of our corrections in the ECD portfolio, we had seen as an overall coverage companies. In that also, the Crown Term has outperformed in tough time, around 8% of a decline. There also the correction in the margin were ranging from the 150 to 300 basis points. In that also the contraction in the margin of the Crown Term is quite a lower comparatively. So I think those who has outperformed in the tough scenario are a better placed to bet on.
One of the things is with this entire AC story, right? It almost as if it became so that ACs are kind of disconnected with how hot the summer is.
Yeah.
Right? It's going to be AC to bigega.
You need
if it's not
the whole year through.
Hot, not hot.
Yeah.
Maybe in the longer run it's true.
Yeah.
But I think in the short run, in the last couple of years, the narrative became it's kind of delinked. I mean, the product from, of course, I mean, the
season
need for it, which is the season. And I think as we've seen in this season, that is absolutely not the case. Praveen, do you agree with that?
Yeah, I totally agree with you that one of the lowest penetrated in this country is RSE, and because of one season we can't take a call, the entire sector. And 2 years back also we had seen the similar kind of situation where the anticipation of the summer were very high, the costs were increased, and the underperformance. So I think in the seasonal product, it's a part and parcel. But the way forward, I believe the long-term growth trajectory is quite a good. The only worry for me right now is the margin profile for the companies because they are within a higher inventory and the liquidation is one of the challenge. Maybe the volume will come, but with a certain price.
Okay. All right, we'll leave it on that note. Praveen, thank you very much for joining in and giving us your view on what we've seen, lots and lots of price damage in the last just 2-3 days alone on a lot of these AC stocks. But for the time being, let's move on and take stock of what's happening in the pre-open session as well. It's quiet. Nifty is down about 21 points. Hindalco is the biggest loser because of those Novelis numbers not going down too well with the market, 2% lower. Nigel's just going to talk about that. On the flip side, actually, we don't have too many pulls on the upside.
I'll tell you the biggest stock in pre-open is Astral. The stock is gapped down. That seems to be the accident of the morning. A Morgan Stanley note is saying that they have missed their estimates by close to around 10% because the pipes division out there, the volumes, were more or less flattish and they were factoring in 7% growth. And also in the plumbing segment, the margins have come in at 10.4%, which is the lowest in 10 quarters. So that seems to be a bit of an accident in the morning, down 5%.
Absolutely. So Astral we have on our radar and we have Praj on our radar as well. Praj is also down 5%. It was a really disappointing quarter for Praj. So watch out for these two large mid-cap companies. Let's quickly get to our stock experts then for the 9-10 calls. Sudarshan, which stock would you go with?
I would go with ONGC Buy ONGC with a stop under 229.
Okay, and what about you, Mitesh?
I'll go with the buy on LNT for targets of 37.30.
Okay. All right. Got that, gentlemen. Thanks very much. By the way, since we're talking about stocks on the downside, guess who's starting on a high? Pretty obvious name. Tilaknagar Industries. Great set of numbers. 30% top line growth. Margins looking good. Stocks up 8.5% in pre-open. And this year, when the market struggled, Tilaknagar is already up about 22%. So some green on the screen should also be discussed. But Nigel, back to Hindalco.
Well, that's right. Hindalco, well, that stock is lower because Novelis came out with a set of numbers, and the numbers are a little bit softer than what the street was working with. The street was working with an EBITDA per ton of around $450 per ton. It's coming at around $432 per ton. What went wrong? The cost of scrap was elevated, which hurts their margins. The tariff worries continue, and the product mix as well was not very, very great. So that means that the higher amount of can sales and good demand for can, but that was totally offset because the specialized products didn't really sell. So that was the issue with them. The total shipments were up by close to 100%, but the adjusted EBITDA, the absolute number as well as the EBITDA per ton, were down by around 17 to around 18%. The tariff impact is clearly coming into play because for the past quarter, it was $28 million of a tariff impact in first quarter. But since tariffs have moved up for the second quarter, they're talking about $60 million of a tariff impact going by the current tariff rates. And a chart should come up for you. The EBITDA per ton, the absolute EBITDA number as well has come down drastically on a sequential basis. But the management is saying they're calling out of bottoming out of EBITDA from here on, and they're believing that things will look up. You'll wonder how when there's going to be such a big tariff impact. They're focusing on the cost side, and now they're guiding for cost measures which could protect close to around 100, which could save around $100 million out. Earlier, they were talking about $75 million. So that's why the second half of the year, they're talking about things looking up because they're looking at mitigating some part of this tariff hit. The net debt level as well has come at the highest we've seen in the last 19 quarters. That's perked up to around $5.5 billion. So put everything together, these numbers go down as a bit of a miss, though we'll have the standalone numbers that will come in by midday. Around 2 o'clock is when we'll get the India business numbers.
Absolutely. And, let's just take a quick look at what the market open is going to sort of start with. And then we'll get down to individual stocks, etc. But we've got movers, right? We've already got a fair number of moves. Astral, of course, is one. Praj is another one, and so on and so forth. Yesterday, of course, it was very positive. Broader markets did very, very well. And there was only one group of stocks which fell, which is, of course, there's all these AC-related names which came under pressure. What do we have? First rates coming through on the Nifty, and then we will, as I said, look at individual names. Absolutely flat for now. 0.14% lower on the Nifty to begin the session. Nifty Bank 50, just sort of, I think, finding its feet, about 0.4 lower, 55,300 on the Nifty Bank. Mid-cap index is flattish. The small-cap index will come up on your screen. I think there's very much there as well. Advanced decline, 800 higher and about 500 lower. That's the advanced decline ratio at this point. So this is what's coming through. 123 odd points change coming through. 250 points change on the lower on the Nifty Bank. Nifty heat map will come up, and it's more up than down actually. So Wipro and Tata Steel and Sun on one end, and Hindalco, Dr. Reddy's are some of the names which are coming through on the other side. Survey.
Yeah, absolutely. That's a mixed board as far as the large caps are concerned. By the way, I do want to point out Praj, though. Praj is a bigger accident than Astral. And for Praj, the EBITDA itself has fallen dramatically, a 60% drop in EBITDA. Their margin last year used to be over 13%. This quarter, the margin's fallen to 4.9%. Something's gone drastically wrong. We'll analyze the numbers in greater detail. But this is not a good-looking reaction. Anyway, let's talk about the large cap screen. And here, in terms of the downside, Hindalco obviously takes the cake, 1% lower. And there's some selling on large banks, ICICI Bank, HDFC Bank, Kotak Mahindra Bank. Banks are weak. The Bank Nifty is actually starting 0.5% lower. Axis is also down. So banks are really on the lower side. And then stocks like Reliance are not really helping. Reliance is flat, not really contributing too much to the upside. So what is up? Let's see. L&T is trying to offer some counter, 0.5% up on that stock. There's some buying in names like M&M and Hero Moto, even Maruti. So auto is seeing some accumulation, steady accumulation actually last couple of days. There's ONGC, which was Sudarshan's call, 910 call. It's 0.5% up as we speak. And then it starts fizzling out. Some buying on Tata Steel as well, by the way. Favorable commentary from China coming in, US-China 90-day window extended. But all said, it's flat for the Nifty, but the bank Nifty is a concern this morning.
Well, that's right, Surbhi, and that's why Hindalco has actually recovered from the day's low because of that deal between, China getting a bit of extension. So from being down 2.5%, it's cut its losses out there, and the management is saying that things will improve from here on. So for the time being, that's bounced up a little bit from the lows. But there are plenty of actually solid earnings reactions. Awfis, we had that management earlier today. They're sounding very, very optimistic about the time to come and about this year itself. Stock is flying away, up 7%. Yatra, it was up 20%. Guess what? Today it's up another 10%. So the street really likes those numbers. Actually, that stock, in fact, has put on more than 30% in a matter of 2 sessions. Tilaknagar Industries, all eyes on how they're going to be moving from a brandy to a whiskey player. But for the time being, the brandy itself is selling enough. So that's why that stock is up 7.5% after seeing a sharp 10% correction in the last few days. Shaili Engineering, that's another one that's actually been one of those big multi-baggers over the years. Then it went through a period of consolidation, but those numbers look quite good. So that stock as well has opened up well in the green. JM Financial, I recall Digantari, when he joined on Finding Alpha, he was talking about better prospects. They've delivered numbers. They've given optimistic guidance. So that is another big gainer this morning. Apex Food, another one that's doing well. And Nelco as well. That's another stock. So there are plenty of stocks actually that are reacting favorably to a good set of numbers. Pull up Nelco. That's another one. HLE Glasscoat, another stock that's actually reacting positively to the set of numbers. So you have various stocks in there that the market's taking note of. They like the numbers. And the stocks, in fact, are seeing a big run. Just add to the list a PG Electroplast. Finally, some kind of reprieve after the kind of selling that we're seeing. The stock has moved into the F&O ban. We told you about this, on closing bell, that there's a profitability. So fresh shorts cannot be added to the system.
Absolutely. I mean, the index is absolutely flat. 24,580 is where we are at on your screen now. So not really running away anywhere. The Nifty Bank was showing a little bit more in terms of pressure. So maybe we just take a quick look at it. About 1/3% lower on the Nifty Bank at this stage. PG Electroplast, by the way, is the number one gainer, volume-led gainer on the NSE at this point in time. So keep an eye on that one. And of course, I think we mentioned the others, which is Tilaknagar and Shaili and Yatra, etc., which are all jumping up. Awfis, of course, as well, about 7.5% gain. Awfis, of course, corrected quite a bit from the highs. So there is that. And, of course, solid numbers. Medi Assist, the block happened this morning, about 5% higher on Medi Assist, 551. So the deal happened on the block window. So I guess institutions participated, and there is that comfort in terms of the clean-out trade, which has taken place. HLE Glass is up 6%. Hariom Pipes was a big mover yesterday, 2.5% higher. Some of these smaller names, by the way, is where bulk of the action is at. Market breadth, it's early, but out of the gates, market breadth is positive, 2:1 in favor of advances at this point of the day. I'm spotting a few of these defense names which are lower. I'm not sure if there's anything to it, but HAL is down 1.5, Mazgaon is down 1.5, Garden Reach is down 2, BDL is down 2. So keep an eye out in this pack as we begin the day. And all of them, by the way, coming up as within the top 5-6 names on the NSE with regards to volumes, but on the way down, price action. Well, let's welcome in Amish Shah, Head of India Research at Bank of America Securities. Amish, good morning. Great to have you back on the program. It's been a while. Thank you very much, and a lot has happened. We can say a lot has happened, and it's kind of 2 steps forward, 1 step back. Just a tremendous amount of news flow to deal with. But Amish, where are you at in terms of your thinking about what the market is likely to do from here? There is general slight amount of desperation which has crept in about earnings being a little slow. Although when you take stock, earnings performance delivery so far has been better than what the general perception has been. The hard numbers show that. What is your sense, Amish? How do the markets do from here over the next couple of months?
Thank you and good morning, Prashant. I think the incremental news these days is obviously around trade tariffs. But even if you set that aside for a moment, I would continue to argue that the fair value for Nifty is 25,000 by the end of this year. We have stuck to that target for about 14-15 months now. I continue to believe in it. That basically means only about 2% upside from where we are, about 6% upside for a year as a whole. So if you're a long-term investor with a buy and hold strategy, I think this is not a great market for you. if you're a nimble investor, able to play the market volatility, if you can rotate sectors, I think then there is alpha to be made. So that's as far as Nifty is concerned, minus the trade talks. The moment you bring the trade talks, obviously that adds to some amount of risk, and therefore whether the tariffs will settle down at 15 to 20 or 25 or 50, the sensitivities vary. So if it indeed stays at 25 to 50%, I think there is a decent amount of downside to the market because markets have not priced that risk in. And that's our base case as well. We don't think that we can continue with a 50% tariff eventually. And as far as the mid caps and small caps are concerned, we continue to believe that they are very rich. They have underperformed this year. They will continue to underperform the Nifty through the year is our thinking as of now. On earnings, Prashant, you are right that they were slightly better, but it is just at the margin. So if you look at the ratio, 52% companies have delivered a beat, 48 have shown a miss. But the quantum of the earnings itself is not that very high. So we had 5.5% earnings growth in F25. On the top of that, we think there will be only 7% Nifty earnings growth this year. So to sum up, I think in between the earnings season, markets may have a rally on the hopes of an earnings recovery. But during the earnings season, I think markets will continue to correct as earnings continue to disappoint.
Okay. All right. Hi, Amish. Good to see you in. You're sounding a little bit cautious then in terms of the near-term view on the markets. But one sector I think you've gone ahead and you've upgraded is IT. Looking at a couple of data points out there, and if you compare IT valuations in comparison to the Nifty, that's only at a premium of close to around, I think, 14-15%. We have normally seen it bottom out here. And if you compare IT valuations with the NASDAQ, actually it's at a discount of close to around 20%. Normally, we have seen it base out at around 25 to around 30%. Tell us what is the rationale with regard to IT? Because growth is going to be very feeble, but now you have the dividend yield, you'll have the cash flow yield as well that could support the stocks. Tell us more.
Absolutely, Nigel. So you're spot on. All the reasons that you mentioned are actually valid, on the back of which we are looking to upgrade it. And it comes back to the point I was making that if you are nimble as an investor and if you're able to rotate sectors, then there could be some alpha generation possibility. So IT, I guess everybody knows that the business outlook is subdued. It's priced it into the stocks. Incrementally, at least the negative news flow from here is unlikely. This, from a positioning perspective, heavily shorted sector. And in case if there is even if the companies just meet their guidance, they don't even have to beat it. I think there's a possibility of a short squeeze. So it's a tactical buy for a large cap sector that we are looking at.
Hi, Amish. Great to have you in. Yeah, sobering thought, right? It's been a tough year. I was just contrasting numbers a while back. Indian market 1% at the index level, whereas the US market is giving you 20% on the S&P 500, 27, 28% just on the NASDAQ. I mean, even if you're just an ETF investor, right? Forget picking any stocks. So since you're saying that sector rotation will be the key to making money in this market over the next couple of months, so IT is one. What else should you keep on your radar to be nimble when that opportunity arises? Because it's moving very fast. Look at these durable companies. They made great wealth and suddenly one knock and all of them got whacked out. So apart from IT, which other sector do you think can rotate on the upside quickly?
So, Subi, two sectors that we have changed literally as of today. So utilities, and more particularly the power utilities. We were underweight on these names all this while. We now think that they're at least fairly priced. You may not be able to generate a lot of positive returns, but they're dividend-paying stocks, can be good defensive in a current volatile market. So utilities goes from underweight to neutral weight. And certain consumer discretionary segments. So we were generally bearish on consumer discretionary and consumption pack overall. But we've now, after the correction, we have now started liking consumer durables, building materials, some auto components, and then travel and tourism. So some pockets of consumer discretionary is what we've upgraded as well.
Interesting. So that's a call on consumer discretionary. You said auto components or also auto? Because large auto is seeing some accumulation. Even the forgotten, beaten down stocks like Maruti, etc. I mean, we're seeing some consistent buying come back over there.
So Surbhi, auto components is the change that we have done. Within the large cap autos, we continue to like passenger vehicles and commercial vehicles. We are bearish on the two-wheelers, but that's not a change in call. We have that call for a while now.
Okay, Amish, just a quick word. I was putting this data out. Another reason for India's underperformance, and this is just kind of sort of, I'm wondering whether this is true, is the lack of AI exposure that investors can take here in India, foreign investors especially. Has that come up as a point of conversation, apart from everything else? Go on.
Well, Prashant, that's a very valid point, and the arguments on both sides. Even for the IT sector, the debate is obviously out there in terms of whether it will benefit these companies in the near term, like a cloud revolution had benefited these companies, or will it disrupt these companies? So there's a debate out there. We are still in the camp that at least as far as the next 2-3 years go, AI will first be an addition to the business for these companies, and eventually perhaps a drag over time.
Okay. All right, Amish, good talking to you this morning. New ideas and perhaps a new approach to deal with a market that's been testing investors' patience as well. Thanks for joining in, and we look forward to more conversations through the course of the year. But now we're moving on to put the spotlight on BSE. BSE actually did pretty well in the first quarter. Numbers showed sequential improvement, whether you're looking at revenue, whether you're looking at margins. So very quick sequential recovery as the dust seems to be settling on a lot of policy changes that, of course, have gripped stock exchanges. So we have with us Mr. Sundaraman Ramamurthy, Managing Director and CEO at BSE. Mr. Ramamurthy, thank you so much for joining in. Good morning to you, sir. And I want to start right there. Investors are taking faith, and they want to believe that the worst of this policy action impact is over. However, we know that there is still a lot in the air in terms of looking at maybe moving the weekly product to a fortnightly product. I'm talking about the index expiry, options expiry. So tell us where you stand as of now with the sequential improvement, and if indeed we go to a fortnightly expiry, then would that be really disruptive for the business and volumes?
Good morning. Thanks for having me in your studio. As far as the regulatory policies in India has been a continuously evolving process. It's a co-created process with proper consultation across market participants. Objective is common. Objective is investor protection. So I think policies have been coming and been evolving and will continue to evolve. As far as the weekly expiry versus fortnightly expiry is concerned, I think SEBI chair has already clarified on this matter. So any question on this and any reply to it will be extremely speculative and an answer to a speculative question.
No, sir, no, I'm not asking you to predict, sir. No, sir, I'm not at all asking you to predict what SEBI will do or will not do. We also did a story. Our colleagues, had some inputs on why this is being considered, the move from weekly to fortnightly. We're just trying to understand that if such a shift does happen, what can the impact be? It may not happen, that's fine. But, as the business stands right now, will it simply halve the volume if it's fortnightly, or will it not impact the volume because people will simply trade that much more? Maybe not every week, they'll trade that much every once in 2 weeks. So just from a structural perspective, what the implications could be?
Well, I appreciate your eagerness. The starting point is still a speculative situation. That if it happens, so we have to deal with it as and when it happens. If it happens, what we all know is whatever is good in the interest of the market is what the regulators will do. So therefore, we need to wait for what the regulatory thought process is, more so because the regulators have clarified.
Mr. Ramamurthy,
if any reply were to be tried by me now, it is based on a speculative thought process.
Mr. Ramamurthy, good morning. Prashant here. The last time I spoke with you, hi, good morning. I asked you about whether the regulator has asked for any information. This is, of course, I think it was in the month of June, right? Whether has asked for information about trades by entities like Jane Street, etc. You said, well, you should ask the regulator. Early July, we got the order as far as Jane is concerned from the regulator. So, but Anyway, I mean, you can't talk about what we don't know
the
yet.
Order vindicates my stand. I gave a reply as well to that question, while it is between what I told was something slightly different.
Yeah.
I told you what conversations happen between regulator and regulated are confidential.
Yes.
Notwithstanding that, at this point of time, there is no investigation on BSE is what I have stated.
Yeah.
The order stands testimony to what I stated.
No, absolutely. Let me just get you this, right? What is your own expectation, right? I mean, I think we last week spoke, you told me that you're increasing penetration with brokers. I mean, that's a big area of effort, right? Getting more players on board on the BSE platform, making their life easier for you to be able to trade, etc. And it's true. I mean, actually, since the first round of these, if I can call it options, derivative market reform in that sense, happened late last year, it should have hurt, but actually BSE's gained market share since then. You're at about 20% share. I think you're at about 25% of the market. What is your assessment, notwithstanding what may come from the regulator in terms of market share, that BSE will continue to, any endpoint, not endpoint, but any target in mind with regards to market share, Mr. Ramamurthy?
No, there are 3 targets which we have. All of them may result in good market share, but market share in itself is not a target. The first target is deepening and broadening of markets, which is very, very important for us. What I mean by that is, we today do not have as many number of participants as we would like to have. We started with 0. Today we have around 500 members. We feel we should increase it to 800 members in derivative segment. We started with almost 0 FPIs. Today we have around 330-340 FPIs. We are targeting at least 500 FPIs should come into India to trade. So at least with BSE to trade. They are already in India, but they are not with BSE. Also, in terms of products, we feel that it should be more monthly mix, more next week, next to next week, next month, long-term contracts, futures. They all should be there in place. So this is what we call as deepening and broadening of markets. And for that is the next goal, which is serving the economic purpose of a product. So the purpose of the product should not be just simply making people trade on expiry day. It should be much about a long-term view on the market and how to ensure that it helps in hedging or an arbitrage in bringing level playing field between the 2 segments. That's the second goal. Third is customer delight. What we can do in terms of products, services, feature, functionality to ensure that the people who are not there feel that they should come to BSE, and people who are in BSE find it more meaningful to be continuing to be stuck to BSE. These are the 3 goals. These are the basis on which we are working on. Every one of our action can be linked to any one of these objectives. Will this result in increase in market share? It may. Why? It's a catch-up game, right? We were 0. We had no product. Today we have a product. So the product starts growing slowly. When it grows, when you're comparing it with the market share, it happens as an increase. As I told, it's actually, strictly speaking, incorrect, because every product is 100% market share. You cannot take 2 different products, put them as a common denominator and consider a market share. Nevertheless, since most of people talk about market share, this is our path.
Mr. Ramamurthy, like last time, nicely done, I must say. In every product of BSE has 100% share. But yeah, I mean, point taken. You're saying 3 goals which may lead to market share gains, but this is the effort at the exchange. Point taken.
All right. Hi, Mr. Ramamurthy. Nigel on this side, and good to have you on the show as always. Let's talk about some things that are in your hands, like the clearing cost. Now, a higher proportion of trades are being cleared by ICCL, which in turn is reducing your clearing cost. So could you tell us, as a percentage, what is it at? And is there further scope of reduction?
I do not know what is the percentage that clearing corporation will be knowing, because it is who they are having as clearing members, and it is an independent entity with its own board. So I would not know what is the percentage market share that they have. But our efforts have been to help them in putting a system which is capable of surviving and growing and sustain itself. I'm not sure whether you're aware, when I joined, my clearing corporation had a capability to trade just 50 trades per second per broker. Today we have significantly enhanced it. With 50 trades per second per broker, if I introduce derivatives, no member who is already even associated with ICCL, even though they are very at time, will be able to clear any trades. We have to increase our clearing capability. Today, on a rough basis, what I can tell you is, we can consistently manage 13,500 trades per second per broker throughout the day, and for longer bouts, 25,000 trades per second per broker without any latency. A peak of around 72,500 trades per second per broker with a latency of around a second is possible. That is what is the system enhancement we have done. Any system enhancement of ICCL, as a person who have been in the market for a long time, I would certainly like to guide them and do whatever best I can. Market share and all is that entity's lookout.
You know, because you're focused on the clearing costs, that's why I asked you about that, because now I think the clearing cost would be as much as NSE, I'm guessing, because it's come down drastically, isn't it?
I wouldn't know, but what I can certainly vouchsafe is their capacity has significantly gone up.
Okay, all right. Okay, all right. Let's focus on the SGF contribution. In Q1, there was no contribution, but various brokerage notes are assuming 5 to 6% of the transaction value this year. Would that be a fair estimate?
So that is a fair estimate which the brokers are doing based on what has been the past. In fact, we have done an exercise where we have seen what is the complex algorithm of computing SGF is different. It is there in its place. Notwithstanding that, for an organization, if it has to avoid jolts of sudden debits to P&L, how do we go about? So when we make a rough estimate, we find around 5% to 6% is what gets into it. We may find a mechanism to periodically contribute to the SGF so that it is all not concentrated in a single quarter and gives very different impression about that quarter alone. That work is in the offing. We are taking approvals and then we will be doing the needful.
Sir, that brings me to where the operations have now stabilized with all the changes. I mean, now we're down to the one product per week expiry format, at least as of now. So if you could tell us, what that has meant in terms of volumes, I mean, overall traction in sensex volumes, and BankX, it's not, because it's not a weekly product anymore, are you still seeing some build-up, or, what is your assessment there? And then, overall margins, because with all of this finally stabilizing and the SGF, the Settlement Guarantee Fund, those costs being where they are, you've come back to 65% margin. Is there scope for improvement?
So first, let me talk about BankX and then I will come to margin. As far as BankX is concerned, you made a very important point. When it was a weekly product, it was seeing a lot of volume. When it is monthly product, it is not seeing as much volumes, and volumes have dwindled. What we find is there is interest in BankX in the expiring week. More the preference is towards a weekly expiry type of a BankX, which is exactly what we want to change. We feel that there is a lot of merit in the market participants looking at a slightly longer time horizon to trade these products. In fact, if we look at the Indian derivatives history, we started with monthly. Suddenly, somehow the focus has become short-term across the globe. And some of the developed markets trading more than 60% of their volume on the expiry day as 0 DTE. I think as market participants, we have a responsibility to go back to the market participants to bring out what are the importance of using a monthly product as it is, which is exactly what we are doing. We are planning to do more. That will help in the mix changing and more institutional participation coming in, and therefore a better economic purpose being served by the derivatives. That work is on, that we will do. As far as the margin is concerned, we are not looking at increasing margin or stabilizing margin. Instead, our focus has been on diversification of our revenue streams. What we would like to have is more of cash equities volume, because we are not growing greatly there. Our market share has not been there. I would certainly talk about market share because the products are same. There our market share has been small. I have always been thinking that if our market share goes up there, it will not be a cannibalization of the other exchange, but it actually by growth in the entire market pie. I have been proved right. When I went up from 5 to 7-8%, now what I am talking about, actually the market size in itself has grown, which I feel strongly about because of multiple economic reasons, which I can elaborate if you were to ask me a question there.
So sir, tell us, if you could give us, sir, if you could give us some sort of an aspirational path on both these fronts, market share, your aspirational market share, and what are the inroads you think you can make in the next 1 year on the cash equity side, and also say the BankX, where the volumes are right now languishing. I mean, what kind of monthly volumes would you aim for, say by the end of this year, as your conversations with market participants and all of that starts bearing fruit?
In terms of BankX, I will not give any volume target because that has not been our approach. In terms of cash equities, we want to have consistent double-digit volumes. At least it should be 12%, 15%, 20%. I'm not aspiring for a 50-50. Then that would tantamount to cannibalization. Interest is not in cannibalization. Interest is in about growing the pie. The pie will grow large, very, very large. Why do we feel that? Because if we are talking about a 50 trillion market cap by 2047 and a 30 trillion GDP, it cannot be with this 5,500 companies listed at BSE. It has to be more number of companies coming in. Are we telling that this 5,500 companies will have such valuation? They themselves from 5 trillion will go to 50 trillion.
Yeah.
Cannot be.
No, sir, right now...
Mr. Ramamurthy, point taken. Point taken, sir. Sorry, we're jumping in and interrupting you. On the derivative side, right, and without going into what the regulator may say or not, do you believe, and the concern has been that the volume of derivative volumes here in India as relative to the cash market has been absolutely disproportionate compared to any other market, I mean US or any other market in the world, and you know the stats very well. Do you think for the foreseeable future, we've seen that ratio has kind of completely peaked out and the direction of travel is more normalization? Would you agree with that statement, sir?
Unfortunately, I am not in a position to agree with you, Prashant, and I have been telling this multiple times in the marketplace.
Right.
When we are talking about US and you are telling cash to derivatives volumes, in US there are multiple exchanges, multiple dark pools, multiple trading platforms. All of those volumes are never measured. Neither the denominator, there are OTC products, there are internalization, neither the denominator nor the numerator is a number.
But sir, even if you add all the dark pools, etc., I'm not advocating for one or the other.
How
but
do
even
you
if you
add the dark pool? You may have the data. I don't have the data.
Okay.
The dark pool per se does not publish you any data.
Correct. You're saying you cannot. It's not possible. You wouldn't say that ratio is peaked. I mean, you would not say that in that sense, right?
See, what I am not able to measure, based on a speculative thought process, it is more. I will not be able to do anything.
Okay.
I am only saying, with lot of dark pools and platforms, the numerator and denominator both are not known in US. How do I compare with it? What is visible to me is the option premium traded in India and the cash market volumes. If I were to compare that in India, it's a fraction of the total cash market volumes. What is visible to me is the number of investors in derivatives market versus number of derivatives in the cash market. That's a smaller volume. Is it true that retail investors are losing money? Honestly, yes. Does that mean the options have peaked out? Very difficult to say. No, the parameters do not indicate that. So it will not be possible for us to conclude that compared to US, we are doing more, we have a skewed ratio because of the point that I explained. The second, based on the Indian data, which is very clearly visible, we are not able to conclude that we have peaked out on volumes.
Okay, got it. Mr. Ramamurthy, getting ready for the NSE listing, sir?
No, this question has been asked to me by CNBC in the last 3 interviews. Always I have told it will be a matter of great pride for me, because I was one of the people who joined NSE in the initial days. It will be a matter of pride. NSE is a prestigious institution To have it listed is a matter of pride, and BSE will feel honored naturally.
And of course, I mean, it'll be a big event in terms of business as well. I mean, 5 lakh crore market cap, right? I mean, in terms of valuation of the NSE. So it's going to be a big one when it lists on the BSE. We'll, of course, track it.
I think as of now, one of the highest traded stocks on the BSE is the BSE. And on the BSE, one of the highest traded stocks since the time of listing is NSDL in the last few days itself. Well, Mr. Ramamurthy, we appreciate you joining in and giving us all of those details. We look forward to having a chat with you rather soon. Thanks a lot for joining in. Well, time to slip into a short break, but on the other side, we have Mr. Balasubramaniam of Aditya Birla Sun Life AMC, who will be joining in to talk about the stellar inflows into the equity mutual funds for the month of July.
Welcome back. Well, we have a special guest with us in the studios, Mr. A. Balasubramaniam of Aditya Birla Sun Life AMC. And you probably saw in that shot on camera that it was all smiles here. And why not? Because in a phase where the market has been testing investors' patience, it's been challenging, returns haven't come in the last 1 year. Guess what? Domestic mutual fund investors have pumped in the highest ever equity inflow into local funds, crossing the inflow number of 42,000 crores in equity funds. In fact, I think in a bit we'll try and see if we can get Nilesh Shah on the phone line as well. I think Nilesh is traveling in a car. He said maybe he'll try and join on the phone because he called this out. We had Nilesh last week. Balasar, we had Nilesh on the show last week, and that was the day the 25% tariff was announced. So it was all gloom and doom. And he said, in that gloom and doom, he said, watch for this number. July is going to be a record number. And it indeed was. It's NFOs that are driving it, sir. But is it sustainable? I mean, can we expect this trend to really rebound? Because, you know, the last couple of months were getting very weak, and now we've seen a big U-turn.
Yeah. I think July was a bit different from an investor's behavior point of view.
Okay.
So I think July is the one which is full of tariff-related discussions. There was a lot of uncertainty. Suddenly it came from global market. The market fell. And when the market fell, then whatever the concern that you've been having that from a valuation perspective, that also to some extent gave comfort to people actually pumping money. So this is the first time I saw, one is NFOs which came from mutual fund industries, so roughly about 9,000 crores they collected. Rest of the money is come through the diversified equity funds. And the moment the market fell, the people actually got convinced that I think I should invest in the market when the market is falling. So that's why I saw participation levels increasing. And large money came through the HNIs and family offices, as well as an ETF flows that also has gone up. And I think there's a record inflow that has come purely on the basis of the conviction that we have on the Indian economy. And domestic savings coming into the equity market continues. And lastly, the RBI policy.
Yeah.
Also, I think the whole stance of RBI policy is now changed towards growth. It's no more the inflation, no more about other stuff, liquidity. Yeah. It's more about getting back on the growth. Therefore, that confidence also gets boosted as a result of that.
No wonder, Bala, I was joking the other day that there are only 3 businesses in India right now with 15-20% growth visibility. AMC's is one.
Yeah, AMC of course will remain because of the role that they play.
Yeah.
Especially on financial savings coming into the capital market through the
tremendous.
The
family office route. Is there a way to measure what percentage of the money, discretionary money, which is coming in, XFSIP, is through the family office route? Because then we can kind of not draw a straight line, but a straight enough line to the promoter stake sales, etc., which are happening. I mean, every year we are seeing about 1 lakh odd crores of promoter stake sales, which are happening. This year also we are on track for that number. And the talk has been that bulk of that money finds its way back into the market through various ways, direct investments, mutual funds. From a monthly flow perspective, is there an estimate?
No, I think the way I look at it, about 27,000 crores roughly is the SIP flows. Largely is contributed to the retail investors. And maybe about 10 to 15% would have come from HNIs in this space. And family offices they come actually into the fixed income funds first. They come into the arbitrage fund. They come into the they look at more like a safety. Because the money which is raised by promoters is not meant for investing in the market. It's meant for other purposes. So keeping that discipline in mind.
I'm not so sure. Investment bankers we've spoken to say that a lot of it comes back into the market.
No, it would come back, but it would also come back to the safety instrument, I'm saying. It will come back to the fixed income, come back to the AIF, come back to the arbitrage funds. So not that necessarily everything comes to the direct.
You're saying it's not that larger?
Not the large component. That in my will about 10 to 15% of the flows would come from the family offices into direct equity. The large component is also coming from the EPFO, basically the ETF, ETF flows come through the provident funds. They can invest up to 15% in equity.
Yes.
And that's the recurring flows. The recurring flows today, 10% can go to the ETF, 5% can go to the actively managed funds. Some bit of money comes to the actively managed fund also. The third category, which is of course is growing, is a fund of fund. So fund of fund used to be very, very small. And now fund of fund also now started becoming a larger component of the inflows. I think the fund of fund, when they start getting inflows, they need to invest in, of course, various schemes. Depending upon your outlook, the money manager have got an outlook on the segment of the market, various segment of the market. That's where I think the flows are coming. So the 48,000 crores that we saw, I think the month of 40,000 crores plus that we saw in the month of July, that I think largely is contributed, the regular flow that is coming in. Some bit of flows I think would have come from the family offices, where they took a call purely on the basis of the market fell, outlook is positive, narrative is positive for India, but market fell, so they used an opportunity actually for pumping. And NFO collection also is going up from what we saw in the month of April and May. The number for July is better than the April and May, June. There's also in some bit of convictions coming back for investing in equity when there is uncertainty. There's one thing which I have seen in the last so many number of years. The maturity levels of investors to invest in the market during the uncertain time actually is far higher than actually investing in the rising market. I think earlier there used to be euphoria, actually chase the market when there is a rising market, rising momentum.
Yeah.
But it's the first time I am seeing, not first time, I am seeing it for quite a number of times, that the markets actually they get more thumbs up from investors when the market falls.
But, Bala sir, also sort of tell us this, that yes, and the industry has done a great job in terms of mobilizing all the money and the new funds and product innovation. But at a level, you also feel a little jittery because insiders are selling, promoters are selling, PEs are selling, FPIs are selling, the whole world is selling. And we as investors are buying, which is fine. We all understand the long term. But looking at valuations, looking at some of these concerns on earnings, is there a risk also that investors will be tested even further? And then we don't want the experience to be soured, right?
Right.
They've already been patient. So your thoughts on this?
So I think interestingly, I was just doing some analysis on this. If you take market as a country, what is the risk that you're running? I think the risk is all about whether it is 6.5% or 6% or 5.5% or maybe 7.5%. If there is a derailment of the growth, then naturally will have an impact on the market and then valuation will get corrected. So today the flow is of course coming in, they're able to absorb all the flow is coming in. Therefore the market actually continues to remain very, very strong. And given the fact that we have seen a good rising market, also given the fact the next 1.5 years is going to be not as rosy as we can expect from the growth momentum point of view, I think it will take some time for the growth to come back to about 7.5-8%. Earnings growth I think will have to gain momentum. In this period, market may go through a sideways. I think that frustration could come. I think we need to, of course, remember very clearly, there will be a period of market where you will not get a return. But staying invested during the period, I think, will become extremely important.
Yeah.
At the same time, if you start comparing that with any interest rate other component, then probably you'll see you would have been better off actually investing in fixed income instruments rather than coming to the equity market. That frustration would come.
Which we're seeing some of that. Like, look at hybrid funds, right? They are drawing in a lot more money now, multi-asset allocation funds, because people have realized that you need to be, diversified, which is good. Correct. But on equities in particular, what is the sense that you get when you speak to your CIO and others across the industry? Because it seems that now this is a market where you need to be very nimble. We just had a Bank of America Securities view. Amish Shah was there, and he says you need to be swift and churn more, maybe, kind of trade in and out more quickly because it's that kind of a market. You don't have the multi-year stories of large banks, IT, 2 years of great returns. So will the approach in terms of fund management need to be different?
Not necessarily. I think fundamental investing doesn't change. I think you invest in companies for a longer term investing point of view. And you go by the company's aspiration to grow the business and so on and so forth. Therefore, the fundamental of investing doesn't change. Momentum is actually part and parcel of the game. I think that's something what your money manager normally does it. It's a 50 to 60% or maybe 68% is a core portfolio. 20 to 30% actually goes to the satellite kind of portfolio, where you actually play the momentum and play to the market, the trend that exists and so on and so forth. Look at the valuations and so on and so forth. That's something more of cyclical. I think structural story in India that's going to remain. Therefore, the construction of portfolio with 100% core kind of portfolios will remain for longer term point of view. That's the only way the money is made. Money is made by money managers, not by just trading. And in the short term, you try and capture the opportunities. Money is always made only if you identify the good companies, good businesses, good business houses. Stay invested for long term. That's the only way we make money. That's why if you look at the difference on the market. If you look at the large cap versus mid cap versus small cap, the difference generally is very high in the long term. But in the short term, actually, it can actually be completely the other way around. That always money is being made only in the long term. That's why we keep advocating all the investors, even the money managers. Generally, they tend to actually buy companies for long-term point of view and stay invested. Except, of course, we have to pay attention on the emerging trend.
Yeah.
The emerging trend, of course, helps you in terms of capturing some of the trend that has got more bias towards short-term performance coming in faster than the rest of the market.
Speaking of emerging trends, just a final point on emerging regulation also, right? Because we know that SIFs are coming, these special investment funds where the basic threshold is going to be 10 lakhs. So whether it is SIFs or any other newer products, do you think actually SIFs could pull in some of the money that's coming in to mutual funds right now? How do you see this evolving in terms of the next 2-3 months?
I think this is another product offering.
Yeah.
I think SIF is actually more targeted towards the people who go to the market and try to test the market, participating in the F&O market and the futures market. For them, actually, the product has been created where the money manager can take advantage of their own understanding of the market and create a product that can actually suit a certain segment of the market. That's why if you look at the flows, the minimum tickets has to be 10 lakh rupees and above. It's actually for the people between 10 lakhs and 50 lakh rupees. It comes between a PMS and the mutual fund minimum of 500 rupees, 1,000 rupees kind of investment. It is meant for that. But there's an asset class that will pick up. The way other asset class got emerged, like hybrid, and within the hybrid, arbitrage fund got emerged. Therefore, there's another asset class will come. But I think the mutual fund industry will be dominantly driven by the large cap fund, flexi cap fund, multi cap funds. That almost 60 to 70% of the construction of the portfolio, or the construction of mutual fund, would come from this segment of the market. And this kind of thing will coexist. The way I think ETF and index funds are coexisting, this will coexist.
So you don't see SIFs pulling money away from traditional equity funds?
Exactly.
Okay. All right, got it. Thank you, Bala, so much for joining us in the studios today and giving us a perspective. Thank you. Well, with that, we go to the market, and the market actually turned around quite well. And look at this, it's a 100-point gain. So after starting very soft, seeing some minor cuts, even the bank nifty, which was down about 0.5%, it's recovered very, very smartly. And we are at the morning highs right now. Lots and lots of stocks buzzing around. Titan, M&M, a lot of the IT names have been doing very well, TCS, etc. All of them tracking gains of in excess of 1% right now. Good time to bring in our technical experts. Mitesh is back with us. Mitesh, bulls are trying to seize control. What's your advice now in the trading calls?
I think, Subi, it is continuation of yesterday's bounce back. As I said, good chance that. And I was actually surprised when we got a soft opening in the morning. But still, looks like the Nifty will head towards this 750, 800 zone. And that is when, you could expect some profit booking coming. That's where the daily and the couple of intraday hours are placed. So till then, I think stay with the long side on the markets. We're about 100 points away from what the level which I'm mentioning. And on the stock side, I think, PFC has come by Power Finance Corporation. Recommend buying here with the stop below 414, target of 432 to about 434 can be looked at. And that about a good reversal is happening on the charts of Tata Steel. So we'll keep a very tight stop at 158.5 and look for targets for around 167.
Okay, all right. Thanks very much, Mitesh, for that. What we're going to do is take a quick commercial break here. Another one. Come back. Manisha Gupta on the other side with a focus on commodities. Stay tuned. Okay, welcome back. It's looking solid. 100 points, 110 points, 24,693. So much better week so far, although it's just the first hour of Tuesday. But I mean, a day and an hour so far this week, and 300 points in the Nifty is what we have. Well, let's just look at commodities and what's top of mind there. Manisha is here with what she's watching closely. Manisha, good morning.
Morning, Prashant. Thank you for that. Well, I'm talking about metals where you have the precious metals on a declining move. But when you look at the industrial metals, they seem to be doing well. I'll start with gold prices, which has fallen yet another 1.5% in the overnight markets towards 33.50. This is a stark price in comparison to where we were on Friday at 35.30. So it has been more than $200 of a decline coming in for the markets there. Well, this comes in after the U.S. president yesterday put on X that gold will not be tariffed. Remember, last week, Thursday and Friday, were a couple of days when it was complete confusion on whether or not gold is going to be tariffed by US. Remember, 230 or 250 tons of gold that US buys, 60 to 70% of that comes in from Switzerland, and that is tariffed by 39%. Industrial metals is a different deal, but when you talk about gold and silver, it clearly has been a stance that it would not be tariffed. So this really created confusion in the global markets where we saw $100 per ounce of a move happen in matter of hours, and that really seems to be easing right now. So when you look at the prices itself, well, we have seen a decline come in. Also, what is leading to decline in gold is U.S. signing an executive order extending pause on U.S. tariffs on China for another 90 days. There's no reason for safe haven buying, and that is the reason gold has declined. The other macro point that gold seems to be taking cues from is that U.S. has signaled that no new sanctions on Russia crude while talks continues. So that also tells you that there's no reason to buy gold and silver right now. So it's not just gold. We've seen silver also decline 2% in the overnight markets. The support, though, comes in for the industrial metals, especially steel prices trading near 7-month highs. The China steel industries may see capacity cuts because of pollution and overcapacity on construction input. That has been supportive. And then there is likelihood of capacity cuts as well. China steel exports have gained up by 11.5% in 2025 so far. Supportive factor there. And also, when you look at the iron ore markets, here as well, we are trading at around 4-week highs. Chinese imports have been at around 100 million tons for the month of July, which is up by nearly 2% on an year-on-year basis. And then also restocking activity in the Chinese mills has been supportive. The aluminum prices also have been on the higher side, trading at near 4-month highs at this point. The Chinese production is up 3.2% in the month of June on a month-on-month basis. But remember, China, for one, is going to cap its output at 45 million tons, and production between Jan to June, in the meanwhile, is up 3.3%. All eyes, though, on the U.S. inflation numbers today, and the further cues would come in from that one.
Yes, absolutely, and we'll look out for those numbers for sure. Manisha, thanks very much for the update for now. We have to take a quick break. On the other side, our special segment, It's the Economy, coming up. Lata Ayan will be in conversation with former Deputy Governor of the Reserve Bank of India, S.S. Mundra, and Bernstein's BFSI expert, Pranav Gundapalli, on the impact of ICICI Bank's sharp hike in minimum balance requirements for its savings accounts.